Okay, good evening, everyone, and welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to master the initial call and properly vet the deal. Call this the Jose special here. And we will go ahead and start getting right into it here. You can go ahead and drop any comments you have in the chat and also any questions you have in the chat. But we'll go ahead and take the chat off the screen for now and go ahead and get into it here. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday at 7 p.m. Eastern is go through an in-depth loan officer training. Tonight's training is definitely something that's great and the base of what every loan officer needs to know. And even experienced loan officers need to either refresh or maybe haven't done this in a while themselves. So this is definitely for everyone to pay close attention to. So Jose, I'll go ahead and turn it over to you so we can get into it.
Good evening, everybody. How are you doing? Tonight's training, definitely a good one, right? I mean, this is the one where we start to put it together so that we can close some loans, right? That's what we're here for. So, interesting title, but a lot to say. How to master the initial call and properly vet the deal. Why is this so important here at the Mortgage Calculator? Is because, as you all know, we have over 5,000 products at your disposal for both our borrowers and our loan originators. So there's a lot to consider. So this is not a cookie cutter operation, right? One size fits all. This is where you really get to excel as a loan consultant. Listen, see what the concerns are, what the borrower's objective is, and then provide relevant and valid solutions. Right. So I'm going to touch base on that throughout this whole presentation because it is so important in this time with so much volatility, so much stimulus, so many different reports, numbers, everything coming at the borrower, that we can build trust and loyalty from our borrowers so that we can all proceed smoothly, everybody working in the same direction to achieve the borrower's objective. So let's get right into it and break it down here. You only get one chance to make a great first impression. So let's begin right here, right? It's real easy when you already know the borrower, you've already done deals with them. So this is a referral, either the borrower doing a subsequent deal with you, also known as repeat business, or the borrower referring you a deal. Either way, those are going to be a lot easier. There's no obstacles, no barriers put up by the borrower. They're coming to you already trusting you, right? With a certain amount of loyalty already built in. But if that situation has not yet occurred, this could be the first touch you have with that borrower. What do you do? Well, common sense here, right? Break the ice and try to build rapport. Remember, you're a loan consultant with a heart. You have to care. You have to have consideration for the borrower's needs and objective. This is not, fast drive-through special, right? You're like a nice, expensive steak dinner, right? That needs to be properly cooked and appreciated well. You're not just going to run right into it. So break the ice, try to build rapport. But at the same time, state the agenda and take the lead, right? Let's see what we can do here to help you, Mr. or Mrs. Borrower. Us, when we're making that call, remember we have to visualize the end result where the customer will request, what are my next steps? That's not going to happen unless you empower that borrower with knowledge, which we will get into here in a bit. Remember that we are the professional and need to instill confidence in our expertise. At the Mortgage Calculator, we always strive to be a loan consultant, and I'm very big on this, and add value to the transaction. How else are we going to compete? In Florida alone, there's, I don't know, I think 210,000 or something like that licensed loan originators, mortgage brokers, and the like. So that's a lot of people, but not everybody's a loan consultant. Not everybody's adding value to the transaction, and the borrowers do appreciate and recognize those traits. You need to understand the issues, right? I mentioned listening, right, up to the determining what the objective are. You need to understand the issues to provide a valid and relevant solution. We're not just application takers, sending out random quotes to borrowers, hoping that we happen to hit the target. That's not how we do. We want to provide relevant and valid solutions. And under no circumstances are you to make any assumptions of what the borrowers actually need, right? We have to listen, we have to analyze, we have to empower the borrowers so that they can make an educated and intelligent decision, and not be sorry for what you got them into, because that's not going to result in any future business for you. And on top of that, it's going to make this current deal, should it close, pretty unbearable. So remember, you only get one chance to make a great first impression. So let's get down into it. You are going to recognize some of these breakdown from the training that I do, especially with the team leaders when we're talking about those new loan applications that come in, that we have to give that initial assessment to our MLO as soon as possible when the loan application email comes in. So here, when the whole thing leads up to this, right? You have the technology, you have the lead, and now you have a borrower, our lead system, and now we have a borrower here, one of our leads that is active, reached out to us and wants some information. So maybe they reached out to us on our ad, and now we are reaching back out to them, calling them up to see how we can assist. So you want to gather as much information as possible to determine the viable, real important word there, the viable program options for the borrower before a quote is ever sent to that borrower, right? Just because they clicked on some ad and they told you more or less what they wanted to do. Oh, this borrower responded to my DSCR ad, and this is more or less what they said they wanted. But you just can't send them a random quote without speaking with them and finding out what is actually going on. That would make no sense. Um, you would not be building any rapport, nor any trust, nor loyalty from the borrower. You're just going to be a number, and that's not really what we want to be. So, like I mentioned there, if you reach out to the borrower on that initial call, gather as much information as possible. You're going to build credibility, loyalty, trust, and very importantly, this is going to create sustainability in your career as an MLO. This is very important. I've been in the business 28 years. Now, in September, will be 29 years that I've been in the business, and still managed to hang in there because trying to handle the business a certain way so that I can create sustainability, right? Maintain yourself in the business, because the longer you're in the business, with more longevity, increases your operating efficiency and the amount of money that you're going to make per deal, including the effort that you're putting into each deal, right? Could be the third, fourth, or fifth time that you're doing that borrower's deal, and each time it becomes easier and usually bigger transactions. So we see how just handling your business in this way, just making that call, reaching out, you're already differentiating yourself from a lot of the application takers out there. So, what are you going to discuss in that call that you're going to have with that borrower before you ever send them out a quote? And I understand sometimes they don't want to talk, sometimes they just want to do it by text, do it by emails. Okay, that's a case by case situation, but preferably the communication. If you're going to be sending out by text, everything you need to tell them is going to be a lot of texting. It's going to be like one loan you're going to do in the whole day, just texting. I guess you can get a voice texting, right? So you're going to figure out what transaction type. Is it a purchase? Is it a refinance? Cash out refinance, rate and term refinance, and then depending on that is other questions you may need to ask. You definitely want to find out about their credit, but specifically certain items of the credit, like first and foremost, their credit score. And remember, ideally, there are three scores. Unless they have limited credit, they may only have two or one scores. Make sure to ask them if they have any of their bureaus frozen, because when it does come time to pull the credit, you want to make sure that those credit bureaus are unfrozen, or else you're going to have to be contacting back the credit reporting agency, asking them to repull the frozen bureau for an additional fee. Doesn't make sense for that extra time and effort if we determine from the beginning that they have some frozen bureaus that they can unfreeze at the click of a button before the credit report is pulled. Uh, so obviously scores, big part of it. Trade lines. How I like to ask them how many trade lines. Remember, the last thing I want to do is pull the credit. That comes at the very end once we know we've asked all the questions we need to do to make sure we have some type of a loan. We don't pull the credit and then see if we have a loan. We have a loan, and then we have the borrower apply. And one of the steps when they apply to the mortgage calculator for a loan is to get the credit pulled at our expense. So again, trade lines, how many do they have? Credit cards, installment loans, student loans, deferred accounts where they co-sign for somebody. If they co-sign, who's paying for it last 12 months? Different things like that. So if you can exclude some liabilities to help with the DTI. And also to know if you even meet minimum trade line guidelines for certain programs. Now, some programs, non-QM programs, if you have three credit scores, there are no minimum trade line guidelines as long as you have three credit scores. But again, guideline specific items there that you would need to check the specific guidelines, all redundancy intended. Uh, you need to find out if there's any credit events. Now, what are credit events? Foreclosures, deed in lieu, short sales, bankruptcies, charge offs, collections, judgments, tax liens, IRS tax liens. And then you want to find out, and remember, you're taking diligent notes through this process, right? Because you're taking these notes because you're talking, and this is an exchange of information. And then you want to find out what are the minimum monthly payments on their liabilities. And again, I know you're going to get all of this from the credit report, but remember, this is the initial, I guess if you want to call this the pre-qual, the precursor to the actual pre-approval, where you're jotting down your notes and seeing where they think they are based on the information that they're representing, which then will be documented by the actual information. But at least to know, so that you know if this is going to be a full doc borrower, alt doc, DSCR, whatever it is, so you can send all the relevant quotes that you can. But I'm getting ahead of myself there. Again, we're talking about minimum monthly payments on all their liabilities, credit cards, student loans. I mentioned all of that stuff. Then you want to touch on income and see what type of borrower they are. Are they self-employed or are they an employee? If they're an employee, are they salaried or are they hourly? Is there any variable income component, right? Like overtime, commission, tips, or bonus? Because then you want to find out if that's been going on for 2 years. If they change jobs, were they getting that type of variable income in their prior job that they're getting now? Because you're already thinking, I know I'm going to need a written VOE for this. But again, this is just right now based on initial intel that you're gathering, right? Just so you know, setting yourself up to have the good, relevant discussion. So then, if they are self employed, further, you need to discuss with them the need for tax returns if it's going to be a full doc loan, and also discuss what are the alt income doc options, such as bank statement and P&L, if the tax return income isn't up to the minimum required amounts. Because, they have a gross amount. You ask them what's your income, you're obviously going to ask them. If they're self-employed, they're going to tell you always the net income. They never, or the gross income. They never tell you the net income. But we go with the net income. But they're like, but why? Those are just my expenses. I'm like, yeah, exactly. Those are your expenses. We can't look at your gross income. That's what our bank statement program is for, or a P&L program is for example, for our self-employed borrowers that want their cash flow to be more representative of their income rather than what they're actually reporting to the Internal Revenue Service. So again, those are some of the income stuff that you're jotting notes down. You're doing your little outline. It's like, for me, it's like a flow chart that I'm writing down there. And then you go over assets. Now, if it's a purchase, that's why we found that if it's a purchase, assets are going to be more of an issue. And if it's a rate and term refi, assets is going to be more of an issue because you don't have any cash out proceeds. So you would need to have assets that are documented in wherever they have them: checking, savings, 401k, Robinhood, anything except crypto, unless it's in an actual crypto bank account in the US. Um, so again, assets available for the transaction as needed. The source of the assets, are they seasoned? Some we do have non-seasoned asset options, like in some of our DSCRs, don't require seasoning or sourcing, just being in the account. But again, that's why we ask all these questions, so then we can send the relevant quotes. And again, getting a little ahead of myself, but you see where this is going. The more intel that you gather, the more success you're going to have in meeting the objective of the mission. That's basically how it is. So then you want to find out if there's any gifts. Why do we want to find out if there's any gifts? Are they planning on having any gifts? Why? Because you want to avert any disasters that may happen when those gifts get transferred to the borrower in the improper manner, and then we can't document it. Like, my father is going to give me 5,000, so he gave me 5,000. How did he give it to me? Well, he gave me $5,000 in cash and I deposited in my account. Okay, did he withdraw that money, that 5,000, exactly from his account? Well, not exactly. He did a little bit over time. He had some sitting at home. I'm like, well, he should have just put it in his bank account and then given you the money. But in this case, now we can't document the $5,000. Now we got to wait 2 months for the money to season in your account, for example, for an FHA loan, as an example. Or so, depending on the seasoning requirements and gift requirements, is going to determine, again, relevant quotes that you're going to send. So as much information as you can gather up front, you can break it down for the borrower. You can empower them and help them make that educated and intelligent decision. They're going to thank you for it because they don't want to prematurely pull the trigger on something, then realize they got in over their head, and then they're going to be blaming you if anything happens, including foreclosure. And then we want to discuss the property. Again, this is maybe more relevant if it's a refinance or if it's a purchase where they already have a property. They may already be under contract and they're trying to pick who's the MLO that they're going to use, which company are they going to use to help them fund the deal. Um, but if it's a TBD, obviously to be determined, no property yet selected, you can discuss what may affect the deal once they do find a property, but you're not necessarily going to have too much info there. But if it's a refi, for sure, you want to find out seasoning on title by the borrower, especially if it's a cash out refi. And if it's a purchase, you still need to find out seasoning on title by the seller. For example, for an FHA, there's the 90-day rule. You got to be on title at least 90 days, so you can't get into contract until the 91st day on an FHA property that's being flipped. And then once you do, there are certain requirements depending on the capital appreciation of the resale, may require 2 appraisals. So different things to consider there on seasoning on title if it's known. Number of units for consideration, LTV considerations, property condition to determine if you may have to go fix flip on the transaction, or renovation loan if it's a primary or second home. And we even have uh, those one-time close loans, which we even have that for invest. Actually, the renovation for investment, we have that for one unit investments, which is pretty cool. So a lot of stuff to consider here, like I was mentioning, that you can ask up front to build up your credibility with the borrower. That's key, building your credibility with the borrower. They stop shopping you around. They're not gonna nickel and dime you to death. They're gonna value your service, value your time, and that's critical because everybody wants the edge in this very competitive period in the real estate industry, right? Everybody wants that competitive edge using the best real estate consultant and using the best loan consultant to help them meet their objective. And that's what we are all about at the Mortgage Calculator. So now you've completed your initial assessment. So now comes a good part at the Mortgage Calculator, right? Or the part that can make your head spin, and definitely why we offer all the support that we do with our team leaders, with me in the Zoom room, helping with loan structures, team leaders helping with loan structures, our Zoom rooms, processors helping with questions on these things. They don't really do structure for you, but they'll help you with basic questions. So a lot of, because there's so many program options, once you start mastering these, I mean, it's going to be like instant synergy being created. So you do your nice detailed assessment or nice detailed call, take your notes. Now you do your assessment. So now you're going to determine program options. And here it is where it is very critical to discuss the borrower expectations versus what may or may not be possible. Now, this is critical because you have to have that alignment early on in the process. If you don't have the alignment on early on in the process, you may never come together. It's just going to be a lot of friction, a lot of spinning the wheels, and no closing. May not even get to an application. Borrower may get frustrated because you're just asking them for stuff, or they're thinking one thing and you're saying another. So it's really important, because if you do have that proper alignment, that intersection where reality hits expectations, if it happens at the right point, that's your deal. That's going to be hopefully the closed loan if you did the proper assessment and the proper analysis. So you're going to discuss with the borrower and their expectations. You're going to discuss with them the credit, the income, the assets, and the property characteristics of this deal. So taking into consideration those four categories, and you're going to let them know what your assessment is after your analysis on what is available. Because again, the proper assessment, which is aligned with realistic expectations, equals a closed loan. And only if they truly understand a thorough analysis are they going to be able to make a thorough decision, an empowered decision, and something that they're going to be able to live with. So empower the borrower with information and knowledge to allow for an intelligent decision and many future referrals from that satisfied and empowered borrower. Remember, they're dealing with the largest financial transaction. Most borrowers, this is the largest financial transaction in their lives. This is scary stuff, and they want to make sure that they're not blowing it, right, and making a mistake that's going to cost them thousands or possibly hundreds of thousands of dollars. So you're going to discuss with them now and talking about all these parameters. Are you going to go agency, for example, right? Well, could it be a conventional, an FHA, a VA, or USDA loan, which is in their horizon? If so, is it something that's going to allow for automated underwriting like DU or LP? Or is it going to have to be manual underwriting because the borrower has disputed accounts that they mentioned, or could have a credit score a little bit on the low side, so you may have to go manual underwrite, different things to consider there. if you're going to go agency. Obviously, agency is all full doc. You'll have discussed credit score minimum requirements, because if they tell you their score is a 560, now you know that's not going to be a 3.5% down FHA loan or a 3% down conventional loan. That's probably going to be a 10% down FHA, or maybe depending on USDA, you may get lucky there if it's in a USDA area and you get an automated underwriting approval. But those are all things that you'll let them know. I'm sending you this quotes, but it's all going to be subject to automated approval. Scores a little on the low side. We won't really know until the system assesses the risk. It's an algorithm that assesses the full risk in the deal. So I'm only sending you options here where you appear to meet the guideline requirements. But if it's automated underwriting, it's subject to automated underwriting approval. And then if we're going to go non-QM, and different reasons why we would go non-QM, right? Buying an investment property, wanting to close in an entity like an LLC or a limited partnership would have to close in a non-QM loan. Are they going to be full doc? Are they alt doc, right? Bank statement, P&L, 1099, asset utilization or asset depletion. Those are all alt doc options. We also have CDFI, which is another alt doc option, because that's really a no doc option for primary or second homes. We just did that the other day. Or is it going to be our flagship program, the DSCR for investment properties? And the DSCR rates are beating conventional rates right now. DSCR, you can close in an LLC. DSCR, you can do short-term rentals. DSCR has a lot of flexibility. DSCR has no seasoning, cash out options, has purchase options at an 85% LTV, right? I mean, conventional, theoretically, I think there's a 15% down option somewhere out there, but I don't think you're going to make it compliance wise with points and fees. And then you got to get DMI. So different things to consider. Any co-borrowers on the loan that you may need, because if so, again, you got to scour the guidelines. If they're an occupant co-borrower, a non-occupant co-borrower, especially in non-QM, guidelines are all over the place on these matters. On agency, there's certain restrictions for occupant versus non-occupant co-borrowers if needed. We mentioned funds, right? Funds availability, gifts transfers, all important stuff to make sure you have structured up front properly. You don't want to think, yeah, and then all of a sudden in the end you can't make it happen because the gift was cash. And then the property value, the property condition, and if it may entail, due to issues of the condition, any renovation loan, like a 203K or a home style renovation, or if it's an investment property and they're just going to do a fixed flip type purchase, a fixed flip type refi renovation loan, and then refinance into a DSCR loan, all things that you need to know on that cycle to make that happen. So again, a lot of things to consider. We're trying to condense a lot of different stuff here in a short amount of slides, but that's how it goes. And when you have 5,000 products, that's why we love at the mortgage calculator, they're coming at us and we're giving them all these different types of solutions. So now, so you've determined the program options, discovered with the viable options with the customer or solutions, and now you're going to send viable quote options, right? So once you determine the data and you get some quote options, you clicked on the icon to see the guidelines for those different quote options to see if your customer fits, right? Because you want to have relevant and viable options. Because, and like I mentioned, all non-QM option guidelines are unique to each investor, and agency guidelines also have investor overlays. So even though Fannie Mae and Freddie Mac's guidelines are homogeneous, the investors that put together the loan packages can add overlays, because that's whoever they're selling the loan packages to have those overlays. So depending on the overlays, they're going to get a little bit more money for the packages. That's what the overlays were all about. So make sure you click on those links, check to see if there's any overlays for any of those options you're sending your borrower, to make sure that they don't fall into one of those restricted groups. And then, as always, send multiple options for different LTV options, depending on the varied down payment options, different income types if they're self employed, even for the employed individual that doesn't really have the job that makes enough income. That's our CDFI options. Full doc and DSCR options if investment, multiple PPP options, 0, 1, 3, and 5 years if investment, non QM as well. And very important here, I mean, unless you want to lose credibility, make sure that your quotes are relevant to the borrower's objective and their individual qualification. That's only going to be known upfront if you do a nice, thorough initial consultative scores. And I'll leave you with a couple of last little nuggets here because every now and then I get these questions that sort of make me wonder. So, yes, self employed borrowers can qualify for agency loans, right? Just because a borrower is self employed doesn't mean they have to go non QM. Just because a borrower is self employed doesn't mean that you have to go an alt doc program or DSCR. Self employed just means they're self employed. And the only time you'd have to go with alt doc is if there's an issue with the income that they're reporting, or maybe they don't have the last year or the last 2 years tax returns yet filed, in which case you would probably have to go alt doc. But just because they're self employed does not mean that they can't qualify for agency. And last but not least, FHA bank statement loans just do not exist, right? I actually saw a couple of these go out. I don't know how they managed to do it, combine bank statement features with FHA and send that to the customer, but that did happen. And no, that's just put those in there as some comic relief. But it all goes back to the initial call you have with your borrower, reviewing the guidelines, and making sure that all your options are relevant. So, looking forward to helping you all structure your relevant and viable deals, which will result in closed loans.
All right. Thank you, Jose. Great stuff. I do not see any questions that came in. No, no questions. All right. Guess you did a good job then. All right, let's go ahead and wrap it up then. Remember, we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern. So we'll be back tomorrow with a new topic. So we appreciate everybody tuning in, and we'll see you tomorrow, 7 p.m. Eastern time.